Hey everyone, George here. So if you're watching this and thinking, what can I do for tax planning for 2025? Things are already pretty late. All hope is not lost. In this episode, I'm going to cover 3 strategies that you could put into effect in the next couple weeks that will give you nice tax deduction come 2025 tax filing. So let's get started. So if your business did well this year, congratulations, you earned yourself a very high tax bill. So you probably are looking for a few last minute things that you can do to get that tax bill down as much as possible. So let's go over 3 quick hitter strategies that you could implement here in the next couple of weeks. So number 1 is the Augusta rule. So this one is a classic year-end move. So if you own your home, you can rent it out to your business for up to 14 days per year, and you could charge anywhere from $1,000 to $1,500 a day. It really depends on your local market rates. You can go on liquidspaces.com and see the hourly rate of what spaces are going for in your area. The hourly rate times 8 times 14, and that'll give you your local market rate that you can deduct at your business and not have to include as income on your personal side. A lot of my clients in the Bay Area and the LA area, they get roughly $1,500 deduction per day. Now for this, you should have a rental agreement for the 14 days. You can't do any more than 14 days. If you do 15 days, the whole thing becomes taxable to you then. Rental agreement up to 14 days. It would need to be rented out. Your personal residence would need to be rented out to your business for things like board meetings, strategy sessions, planning days, and your business would actually need to pay you on the personal side. So cash transfer for the amount, let's say $21,000, would need to happen from your business to your personal and record it. So this is a legitimate deduction. December is fine. You can squeeze this in for whatever time there's left. Number 2 is the cost segregation. So if you use any part of your home for business use, let's say you use your garage, you run your office out of there, and that's 25% of the square footage of the total house, you can get a cost segregation study done. And in 2025, with bonus depreciation rules, the way it works with qualified improvement property, everything under a 20-year life, you could bonus depreciate for the year. And you do need to get this cost segregation study done. It's a third-party report. It's an engineering/accounting report. And for that 25% business use portion, you can get a deduction for the qualified improvement property for that portion. So let's say you had $1 million house. That's what you bought it at. And they go off lower of cost or market. So let's say it's $1 million, your cost basis, and 25% of it is business use. And roughly 20% of that is qualified improvement property that you could bonus depreciate in the current year. That means that with a cost segregation study done, you can take bonus depreciation of $50,000. So that's $1 million times 25% business use times 20%. That's our rough estimate. That actual amount may vary. Roughly 20% qualified improvement property. So that'll give you a $50,000 bonus depreciation deduction in the current year. But you do need to get a cost segregation study done. So that's a $50K deduction right there roughly. Number 3 last minute deduction is a SEP IRA. So SEP IRAs are one of the few retirement plans that still work after year end. You can make the contribution to the SEP IRA after year end as long as it's before the filing of the tax return, assuming the tax return is filed timely. The only thing is that you needed to have paid, you need to have self-employment wages. So you either needed to have W-2 to yourself, or if you're a Schedule C, sole proprietorship, single member LLC, one of these, they go off of effectively the bottom line of your taxable income because that's your self-employment earnings. So you either needed to have payroll yourself in 2025, or you need to have some sort of Schedule C or sole prop single member LLC income, and it would be based off of 25% of your self-employment earnings, so either your W-2 or your Schedule C net income, and capped at $70,000. But the point is that assuming you do have self-employment earnings in 2025, you can make the SEP IRA contribution even after year end, as long as it's before the filing of a timely filed tax return. Then you can get the deduction still even after year end. Another quick one I want to throw out there is hiring your kids. However, we only have a couple weeks left. The idea of paying your kids and shifting your income down to their much lower tax bracket is that they actually do need to have performed work for you. So there is that piece of it. So I mean, if you went, all of you, and did a modeling shoot, used it for your holiday cards, things like that, you paid them what is a reasonable comp for, your like modeling for advertising, promotional expenses, that could possibly work. I don't know if the fair value of that would be up until $15,000 per child, but you might be able to get something. Now, there's a lot more out there in terms of tax strategies, but the key is that you really need to be planning ahead. The sooner in the year you could set all the plans up, do all your planning, the more you can actually incorporate in the year legally and validly. But these are three that I really wanted to just throw out there, and four, including the hire your kids strategy, if you want to get some of that in. Like these three tax strategies alone, I mean, we're talking about Augusta rule, roughly, let's call it 21,000. A cost segregation, let's say on $1 million cost basis, a house, that's 50,000. And SEP IRA, let's say you paid yourself $60,000 in payroll, that's $15,000 right there. So just between these three strategies alone, you can get an $86,000 deduction right there, which hopefully helps with your tax bill, get it down quite a bit. So I hope you found this helpful. Click like, subscribe, turn on notifications for any updates, and hope to see you in the next one.